Myles, Nowik here from the Nowik Mortgage team, and today we've got some news for you. The Bank of Canada cut rates by 0.25%. I'm sure you've seen that all over Facebook, YouTube, Instagram, and everything in between, but the real questions is how is this going to affect you? So today we're going to take a deep dive into this and try and see if we can answer some questions that you might have and maybe shed some light on what the effects of this are going to be. We're going to be touching on how this is going to affect you and why the Bank of Canada did this. So stick around and let's dive into this. As mentioned, the Bank of Canada made a recent decision to cut the overnight rate by 0.25%, dropping it from 5% down to 4.75. It's not a massive cut, but it's a step in the right direction. Now, the big question is who is going to benefit from this immediately? The first person benefiting is the person with a variable rate mortgage or a home equity line of credit. That is what is affected by the prime rate of Canada, which is going to drop due to this recent announcement. Now, I got to say, it's a quarter point. It's not a lot. So when it comes down to it, the effect on your mortgage isn't going to be quite as dramatic as some people may hope. For example, if you've got a $500,000 mortgage sitting at prime minus 90 on a 25-year amortization, your mortgage payment is going to go from roughly $3,289 to $3,214, right? So not a huge decrease, but as mentioned, this is a step in the right direction. Now, there's two types of variable rate mortgages out there. There is the static payment variable that you see with lenders such as TD Bank and some of our credit unions and things like that. And then you've got your adjustable rate mortgages where the payment actually moves up and down with the interest rates as they increase or decrease. So the above mentioned numbers with the payment decreasing and all that stuff, that's going to be what effect happens to those people with those adjustable rate mortgages. So they've been riding payments as they come up and now they're going to start riding them down, which is really quite nice. Now, for people with those static payment variable mortgages, unless you've hit your trigger rate, your payment has stayed the same even as rates went up. Now, as a mortgage broker, we see lots of things, including a 90-year remaining amortization on a mortgage. So essentially what's happened in this case is as rates have increased, people's principal payment has decreased to the point where they're now interest accrual. So this is going to put you in a position where all of a sudden you're going to start paying your mortgage down again, which is fantastic because when those mortgages come up for renewal, there could be some major payment shock if we can't get those amortizations back to normal. Now, if we take a look at fixed rate mortgages, a lot of people have been asking that there is no direct correlation between the prime rate and the fixed rate mortgages. Those are governed by the bond yields in the bond market, which is governed by a whole bunch of things that happen globally. Now, there is a small adverse effect. So for example, with this recent rate cut, we saw, I think it was a 0.071% decrease on the bond yield, which puts some downward pressure on the rates. But considering we saw basically the same amount on an increase previously based on U.S. debt loads, it really hasn't had a huge effect on those fixed rates. And I don't think we're going to see a huge effect on fixed rates from rate cuts until they start increasing those to the point where they're cutting down by a full percentage point or more. And I think when it comes to rate cuts on fixed rates, I think a lot of those are already priced into the market. So it's one of those things where we're going to have to pay close attention and really watch it. I do think they're going to go down, but I think it's going to go down in a different form and a different speed than we're going to see the variable rates go down with the prime rate of Canada. Now, when talking about this stuff, there is an impact on potential home buyers, and we want to touch on that. The impact on potential home buyers is really nothing to do with affordability. Right now, the variables, even with this cut, are higher than the fixed rates available. So if we're going for maximum affordability, you're going with those fixed rates. But it does put us in a position where we could potentially look at these variables as a viable mortgage option now. And there's a couple of strategies behind that. If we take a variable now and rates continue to go down, which they might not, but the data is showing that they should, you can ride that down. And not only is your payment going to go down, but your 3-month interest penalty is going to decrease as well, based on the fact that with a variable, that's the only way to guarantee that 3-month interest penalty. So that is some potential there. The other option that we look at is taking that static payment variable. So let's say you're buying a house and you see the variable, and let's say we're prime minus 90, so we're, I think, 605, or let's say we're at 6%. Are you okay with making that payment? Because if you are, you take that, you make that payment. As the rates come down, you're all of a sudden going to be putting more money towards your principal because your principal is increasing because the interest cost has decreased, but your payment stays the same. Therefore, you're paying your mortgage out faster. And if you can knock 5 years off your mortgage, the amount of interest savings is dramatic. So when it comes to, the impact on homeowners, not a huge amount, just gives you a bit more options. And if you're willing to look at some additional strategies, it can benefit you that way as well. The other question I've been getting a lot today is potential risks. And if we want to talk risks, there's something that needs to be brought up. The U.S. economy. So we have cut rates, the Feds have not. We can diverge from the feds to a certain point, but if we diverge too far, all of a sudden that's going to push inflation up again. And then they could potentially have to hold rates or increase them again. So they're going to have to really walk a fine line with how quickly they decrease them. And even there, Tiff Macklin said in his press release that they're going to, I'm not going to word for word it here, but they're essentially going to price out further reductions based on the data in which they receive. And when we look at the data, and it's the reason they cut rates, for one, we can't talk about cutting rates without lowering inflation. Inflation was up at 8%. We're back down to 2.7, really close to that 2% target. So inflation's been going down, which is fantastic. That's exactly what the Bank of Canada wanted to see. On top of that, our GDP growth has slowed down. It's at 1.7% when they thought it would be higher. So all these signs indicated, yes, it's time to cut rates. But they're going to do it, and they're going to err on the side of caution because they don't want to cut too quickly, and they don't want to put us in a position where they have to jack rates up further. In my firm belief, and someone might have a different opinion. If you have a different opinion, let me know. But in my opinion, they're dipping their toes in the water, and they're testing the water to see what happens. They did a quarter-point cut. They're going to be watching very closely to see what happens with the economy and inflation and GDP growth and all these other different things. We're still seeing the job market where there's lots of hiring. It's slowed down a bit, but there's still lots. So they're going to be paying really close attention to it because all further rate cuts, as mentioned by Tiff Macklin, and as I mentioned before, are going to be based on the data in which they receive. If they receive data that shows that inflation's going up or anything like that, they're going to put a pause on it. They're going to stop because their goal is to stop that massive inflation that we were seeing before. So I think they are tipping their toes in the water. I think they're testing it to see what's going to happen. So in closing, and the key takeaways of this, inflation's down. GDP growth is down. Rates are going down. Everything's going down, and it is great. It's about time we saw some rate relief, and hopefully there's going to be more on the horizon. I'd say we'd see 1 or 2 more rate cuts before the end of the year and more going into next year as long as the data maintains in the direction that it's going, and that would be a very welcomed change.